fears of an economic slowdown brought on by the most aggressive Fed tightening cycle in history have, to date, been unfounded. The longer rates stay restrictive, the greater the impacts will be, but the tightening of monetary policy has been offset, at least to some degree, by continued fiscal spending. And on this front, it's clear spending will continue. Overall, the monetary and fiscal response to the pandemic would have to be deemed a success, as unemployment declined rapidly, and as of April, we've enjoyed 27 straight months of headline unemployment below 4%, a streak not seen in the U.S. since the 1960s. Economic growth, as measured by GDP, has also been significantly higher in the U.S. than many of our developed country peers. The question from here is how sustainable our current economic path can be. We are beginning to see some productivity gains which provide a path forward for growth, particularly if we can move forward with some sort of a cogent immigration policy to enhance the growth of our labor force. Both factors can provide a higher growth outlook and give us some additional confidence that inflation can decline sustainably to the Fed's 2% target. In the near term, inflation is remaining a bit sticky, which, along with a history of inflation coming in waves, is giving the Fed pause as they consider the risks involved with lowering rates too soon, especially in the face of continued fiscal spending. Additionally, while short-term fiscal spending is additive to growth, the increase in the amount and cost of our debt is becoming a material budget factor quickly. Our fiscal position is not in a crisis scenario, but it is something of which we all need to be aware moving forward. This election cycle may end up being like nothing we've seen before. Yet while policy differences on subjects like trade, immigration, taxes, and deficits are wide, the narrow divide between the two major parties may limit the scope of actual changes being made. Our base case is for the economy to continue to grow, corporate earnings to remain supportive of valuations, and we expect the next move from the Fed to be to lower rates.